Welcome back to another Market Radar podcast. We had quite a few notable trend shifts this week. So the S&P futures are now neutral trend. We did get a bullish trend flip on the NASDAQ. Russell remains bearish trend, still quite a ways to go. And the Dow Jones neutral trend as well. So definitely some shifts going on. The Nasdaq is leading as usual. It's been a lot more volatile than the other indexes, but ES remains neutral. So we do not have a definite direction in mind. We'll have to see what happens here, but that's why we have our regime model, which helps us stay in line as well. We kind of look at the broad overview of all assets, not just equities, to determine which regime we're in. And that kind of helps us get direction more when DDAP is not able to quite give a direction, where right now we have this neutral trend. Bonds, on the other hand, really didn't do much. There's not much going on in the bond space. What do you think that means? Is there the move in the Nasdaq and all equities was really brought on with the lower than expected CPI print. So the market I'm seeing as the market's liking where this is going. It's liking that a recession actually might come and it's not going to be that bad. The whole soft landing idea, and bonds aren't really showing that. They're not really giving us deflationary signs.
Yeah, so obviously, this week was a monster week in terms of market moves versus economic data, right? It was really just a 10 basis point print on CPI that sent the ES futures up over 200 basis points and the NQ futures up over 200 basis points, with ES barely up 200 basis points, right? So we had a pretty much 2% move across the indices there on a marginally better than expected CPI print. Now, that's a good thing, right?
Yeah, I
Obviously,
guess I
once the
mean
inflation come down,
yeah.
right?
So
That,
the market essentially wants deflation, not a strong deflation.
more so disinflation, right? The market wants disinflation, but not deflation, right? Deflation is
Yeah,
where we're going to get that negative decrease in prices, and CPI theoretically goes negative. Now, the market can price in deflation in different ways, but it's more so disinflation. The market wants inflation to slow without falling off a cliff, which would be obviously signaling a recession, and in turn, growth stabilizing where it is right now in that 1.5 to 2% range in on real GDP, and everything kind of chugs along in a what would some would call expansion or Goldilocks regime. Now, obviously, like I said, good thing with inflation coming down. The move in the markets are quite interesting because if you're going to really expect a higher, or I should say, a lower inflation rate, higher probability of soft landing materializing, which is pretty much all of what the media was talking about this week, is soft landing this, soft landing that, and pretty much down to the point of that everyone is starting to really believe that the soft landing is the only outcome in this scenario, or the most of the highest probable outcome. And that is something that the bond market will pretty much end up deciphering for us, right? So the soft landing is, what you guys are seeing right now in terms of how the market is picking up and putting together this entire scope of the soft landing, from how it's happening right now, how it's gonna affect the market down the road, how it's gonna affect earnings estimates, so on and so forth. That's all part of stage three. We're still deep within stage three. We're slowly climbing out of it, but we're still there. I've laid out multiple times on Twitter what needs to happen for us to get into stage three, what you need to watch. And I've also made a ledger note in our members area on our website that indicates everything that would have to really get, or should trigger, right, to get us into that stage four environment. So stage three is all about everyone pricing in the soft landing. Now, what ended up happening here is yields did come off their highs as bonds did catch a bit off the October lows. But given to where they've moved versus where equities have gone, it's quite drastic, right? Like, interest rates haven't come down a lot. Now, you might be thinking, well, if they come down a lot, that would be a signal that the economy is slowing. And that's exactly the point, right? So what we're seeing happen here is rates coming up a little bit, not too much to where it's like problematic and where everyone's like getting scared, but okay, down enough to where, I mean, if we look at the 30-year, right, rates are down enough to the point where it's like, okay, they're no longer above 5% on the long end. We're slightly over 4.5. So things are slowly coming back down. That's good for the market. And sure enough, equities are up on that. And the problem here is when rates start falling, eventually we get to the point where they trigger that bearish trend move here, or on long bonds, they trigger a bullish trend flip. Now, that is a key indicator in going into stage 4. So the reason the soft landing is part of stage 3 is because it's this idea that, think of it like a roller coaster, right? You're coming down and you get launched up. And as you get launched up, everything starts slowing and slowing and slowing. And then when you get to the top, you almost stand still, right? And then you drop again. And this idea of standing still is everyone can look around, look at each other and say, whoa, nothing bad happened, right? But they're not looking in front of them. They're looking to the left, looking to the right. They're seeing that, okay, there's no damage here. There's very minimal damage here. Unemployment's up, but it's not up a lot. Okay, maybe we can put this together. And the key to all of this comes back to the Fed, right? Because at the end of the day, the Fed put us in this situation with their monetary policy back in 2020. They launched this rocket, and they had to rein it in 2022, and they're still working on that right now. And the Fed is ultimately the dictator of how this all plays out, because they will rein in the market to a degree, and they will, or I should say, they will rein inflation to a degree where they deem it's necessary, and then they will manage it from there. So something we can look at are break evens, right? And these are the 5-year break evens. I've covered this specific chart with this layout for a while now. Okay, so anyone that's new to the podcast, if you go back to any of our old episodes, you will see this chart. On Twitter, you will see this chart. And what this chart is telling you is something real simple. It's telling you the average expected inflation rate over the next 5 years priced by the market. Now, the market's pricing in a 2.23% rate of inflation over the next 5 years. Obviously, this is well below the 2022 inflation peak, where the peak fears of inflation, which was almost at 3.75%. We are now down to 2.23. Right going into SVB earlier this year, we actually got up to almost 2.8% before it coming down hard after the SVB collapse. So ever since we pretty much came into this range back in 2022, we've been in this chokeout zone for a while. We did peak out above it briefly at the end of October and then fell back down quite aggressively. Now, what is this telling you? Well, this is telling you that inflation expectations remain well anchored. They are very well anchored. They are not really breaking out. You could make the claim that they're pretty much climbing ever so slightly, but nothing substantial, right? It's nothing like we saw here in 2021 and 2022, where things were just getting out of hand. Obviously, everything's down to earth right now and being contained very well. Now, the problem here is, though, we're still above the Fed's target. The Fed is looking for a 2% inflation rate. Doesn't mean that this has to be printing at 2%, but what it is going to mean is, over the long run, the Fed wants this at or below 2%.
Well, is it possible to average out at a higher inflation rate? And wouldn't that also kind of be the soft landing scenario? So the Fed doesn't need to be as restrictive if they're okay with staying at a higher inflation rate?
Right, but they're not, though, right? So this is the big dilemma that everyone's having with this idea that rates can stay higher for longer. Higher indefinitely. I'm sorry. So the big issue is the Fed has to be very firm on their 2% inflation target. I don't think we're going to see the Fed break that 2% inflation target, no matter what anybody on the internet wants to tell you. All this nonsense about, the Fed's going to have to leave the 2% inflation target, like the 4% is going to be the next 2%. No, I don't think so, because I think that the Fed's main objective is price stability and employment. Literally, the only reason that Powell gets up on the stage is the only thing that Powell gets up on the stage for is to claim he does those two things. And for the last shred of their credibility, I think that they cannot do that. They can do a lot of other things. They can restart QE and call it not QE. They can play all these little mind games if it's funding debt, whatever, however they want to play their financial games, they can play it. But in terms of actually controlling inflation, I think that that's one of those things that they really can't get away with, at least not in the current time. And I think the Fed is not going to break that 2% inflation target, meaning they're going to remain restrictive. Now, it doesn't mean that, okay, so right now, if we look at CPI at 3.2%, the Fed's at 5.25%. The Fed is we've been saying this for at least 6 months now. The Fed is well into restrictive territory, meaning they are firmly restrictive. They do not need to do another hike. There's no point. They're well above inflation expectations. They're well above the inflation, realized current inflation in front of forward inflation swaps across pretty much all tenors. They are in the positive. So they don't need to do much. They just need to hold. This is where the problem comes in. Is if the Fed is looking to get inflation under 2%, they're going to have to hold rates higher for longer, which unless there's a recession or a drastic slowdown, the Fed is going to pretty much be stuck in this range, possibly bringing rates down 50 to 100 basis points while still remaining well above the expected inflation rates over the following 12, 18 months. They can't really cut too much because what's going to happen is they're going to actually ease the economy too quickly and without getting inflation to target. And this comes back to the idea of the Fed having to thread the needle. Could they do it? Obviously, it's possible. They could thread the needle where they can cut interest rates slowly, actively, and basically in line with inflation falling.
But I don't think they want to do that. I think they would.
I don't think so either.
They always would rather play the safe card and be late to the party, but at least they have inflation under control, because the last thing they want to do is create another inflation problem.
Right. And I think that's where this comes back to the Fed making sure they get inflation back to their 2%, 2 / below percent target. Obviously, we can definitely see inflation hover around 2%. It doesn't mean inflation has to be firmly below 2%, but it would be a good indication if forward inflation expectations like these break-evens go lower than where they were in some point in May of 2023. And I think that until that really happens, the Fed is almost looking at this like inflation expectations are still a little too firm. They need them a little softer. So they're going to hold for a bit longer.
And that's when the bond trade would really present itself as well, once we get down closer to that 2% range on these break-evens.
Right, because what's going to happen is as these break-evens start falling off, bond yields are going to start falling off as well, and we will most likely get that bond trade that everyone is looking for. Now, I want to make this clear. I am a believer that stage 3 will lead to stage 4. It's the most probable outcome. And I've been saying this since the day one. Is there a possibility that we can hit stage 4 and it's very shallow to the point where we don't get so much of an equity drawdown and the economy doesn't really get that hurt and rates can stabilize at a lower price lower yield, without completely collapsing? Of course, but you're talking about pretty much every bet aligning perfectly there. I don't think we're going to see it. Could it happen? Obviously, this is the stock market. Anything can happen. We have to play with what's most probable. So I do think that we're going to go from stage 3 to stage 4. We're going to see things like crude really break down. We saw that starting this week a little bit. We saw, we saw crude pretty much break under Momo, flipping neutral trend now after being bullish from August of this year. So that's an early indication that something's flipping on crude here. Obviously, the bearish trend flip on crude would be more indicative of that stage 4 move. We're not there just yet, but we're not at the stage 3 peak of economic state normalization. Equities might be up, but obviously, remember, we came out in August of 2023 saying stage 3 is going to initiate, and that's where pretty much we're going to start to see this this GDP growth peak, where everyone's going to price in the soft landing, which we saw last quarter with a 4.9% real GDP print. Now we're looking in the 2s. The question is where we go on from here. And obviously, if we start fading harder, we're gonna see that present itself in that move from stage 3 to stage 4. And we think stage 4 is the most likely outcome at this point in time. And that's why break-evens holding up the way they are is a stage 3 signal until they start breaking down, which would signal Fed rate cuts. You can call it, the way you can look at it is break-evens breaking down gives the Fed the authorization to bring rates down because real yields are going to start expanding beyond their current level of restrictiveness, and the Fed will actually end up just getting more and more restrictive, right? Because the Fed's holding at 5.25, and real yields are at 2.25. Break-evens, excuse me, break-evens are at 2.25, and let's just say real yields are at one column one in. Here we can look up real yields right now. So let's just take a quick look at real yields. Let's say real yields are 2.18, and the Fed's at 5.25. So there's about a 3-point spread there, roughly, right? So as break evens start falling, real yields actually, without the nominals breaking down the Fed holding, real yields will continue to climb. And what that's going to do is add restrictiveness to the economy. And ultimately, real yields fall in stage 4. They go sideways like this in stage 3. Ever since August, they've been pretty much going upwards and sideways like this, as we've drawn here. And they will eventually fall and go downwards in stage 4. And this all comes and ties back down to Fed QT. So obviously, there's a lot of questions around this and around the reverse repo.
Right. We actually haven't talked about the reverse repo in a while, but I remember when we were up in the 2 trillion range, we did say that as this drains, it's going to provide liquidity in the stock market and in the bond market. And now we're seeing exactly that. And I've been seeing some people on Twitter saying that once this completely drains, gets down to zero, that liquidity dries up and the Fed can no longer maintain QT for as long as they want. Obviously, it's not going to be like a flick of a switch, but it's going to put added pressure on QT and force the Fed's hand. Is that something that's going to happen?
So no, obviously that is not the case. Just because the RRP hits zero doesn't mean the Fed is going to stop QT. As you can see here in 2018, the Fed was doing QT for quite some time after the RRP was, in fact, zero. They did it for almost a year, eventually running into a repo crisis in the late stages of 2018, I believe it was 2019. We hit that repo crisis. So let's go over here exactly what is happening in the short-term repo market. So it's real simple. We have 3 lines here. We have the interest on reserve balances. This is the rate that large banks, because not every bank, only the large banks can lend their reserves, to the Fed. Now we have the overnight reverse repo rate, which we all are familiar with. That's the rate that money market funds have been investing into the last year and a half. That is where the excess cash in the economy goes into. So, real simple, what has been going on here? Well, after COVID hit, the Fed flushed the system with cash. And so much to the point where they had so much cash in the system and they had to go to alternate places to put that cash to work, because there's only so many treasury securities that can be bought before there's actually more cash than treasury securities available. And that's one of the main reasons why the reverse repo exploded after 2020. All this excess cash got piled up on the side and need to go somewhere and get that yield. So it went to the reverse repo, because if we take a look back here in 2020, 2021, what ended up happening was the purple line here is the SOFR rate. So that's the secured overnight funding rate that is traded, and typically is trading very close to the rate that big banks are getting at the Fed. But not only is it not trading close to where the big banks are lending their money, it's actually trading below the repo rate. And why is that? Well, SOFR rate is collateralized, so it's trading with treasury securities. And if there's not enough treasury securities, that SOFR rate is going to get bid down because there's a low supply of securities. So there's a lot of money chasing a few amount of bills, the rate goes down. Very simple. And we saw this pretty much go on for quite some time up until the later stages of 2023, when the SOFR rate got back into what would be considered more of a normal range, right? And the indication here and what's important to pay attention to is the exact reason why QT won't just end directly when a reverse repo account hits zero. And that's because the whole reason the Fed is doing QT is there's too many or too much reserves in the financial system. Now, using this simple chart, we can pretty much plot out a diagram of the reserve conditions in the banking sector. And you might be saying, well, how can I see that? And the answer is pretty simple. If we go back in time, pre-COVID pandemic, you'll see that when the Fed was doing QT in 2018, the SOFR rate, and we'll actually enable the Fed funds rate to give a better explanation. So long story short, SOFR rate is just a more enhanced Fed funds rate. So the purple and black line, they're pretty much the same thing, but they're not the same thing. You don't need to worry about that. Just understand the way the chart's moving. You'll get the picture. The black line and the purple line are near the interest on reserve balances, right? That's where the big banks are getting are lending money at, and that's because there's not enough reserves in the system for the big banks to lend all that money out of the system to the Fed, and then more money to float around and push bill prices lower. There's not that many reserves. What this is telling you is the reserve situation is actually quite tight, and as this starts picking up and actually trading above that upper bound where banks are lending money to, you can see that there's actually a reserve shortage. And then we had finally something break where the rates on overnight funding, or the overnight funding rates exploded higher. And this was basically an issue where the Fed drained too much collateral from the market, or too much reserves from the market, and to the point where there wasn't enough, call it oil in the tank, to keep everything running smoothly. So if we go back to where we are right now and we take a look at what's going on in the current market, in the current situation, the short-term funding market, you guys can see that there's minimal stress here. We're still not up at that upper bound, and that's primarily due to the reverse repo eating a lot of this stress, or eating a lot of this pressure the Fed has unloaded via QT onto the market. And once we see QT pretty much get down to zero, and zero, the RRP get down and zero out here, we're going to really see the overnight the overnight funding rate start to lift up and grind towards that IORB, the interest on reserve balances, as banks end up, or as money, in the financial system ends up decreasing and the liquidity slowly worsens. So it's not just a simple thing.
Tying this into the whole stage 4, stage 3, right now, this is telling us that we are still in stage 3. There isn't a liquidity issue. And once we start seeing that purple line heading higher, we're kind of starting to see liquidity start being drained from the system. And that would be an indication that we're heading towards stage 4.
Right, exactly. Because as of right now in the RRP, all we've been seeing is a drainage of excess liquidity, of extreme excess liquidity, I should say. We haven't really seen a drain of real operational liquidity, right? This money's just parked on the sidelines.
Right. We're not even down to normal levels of liquidity yet.
Right. And I think that once we get down, we're going to start to see the SOFR rate really pop up more, because there's less pressure in terms of cash flowing around in the market. I mean, again, this might not look like a big improvement, but if we just take a quick look to where we were about a year ago this time, we were trading below the overnight reverse repo rate, meaning people that were transacting in the short-term funding market were getting paid less than people who were just keeping their money parked at the Fed's overnight reverse repo account. Obviously, that's changing. You should get paid more if you're dealing with counterparties that aren't the Fed. And that's pretty much what's going on here now. We're starting to see people that are transacting at a rate higher than the floor that should be set. But the Fed had a hard time here, the first half of the of this rate hiking cycle, of keeping the markets pretty much situated at a rate above the floor the Fed was setting, because there was just too much reserves in the system. So we pretty much eradicated that issue, and now we're slowly going to have to get the reserves further in check here, because naturally the SOFR rate should be trading much closer to the IORB rate than the floor, meaning this purple line should be trading much higher and much closer to this orange line than this yellow line. So I think that once we see this, So once we see this purple line really get towards that orange line, I think then we can really start talking about the Fed cutting QT. But keep going. What were we saying?
Okay, well, that's what I was getting at. Was is this going to force the Fed's hand and stop them from doing QT? Because that is something I see people mentioning on Twitter, that the reverse. So the reverse repo, they're looking at the reverse repo. They're not even looking at the SOFR rate here. They're just looking at the reverse repo, and they're saying once that hits zero, it's going to eventually, shortly after, force the Fed to stop QT. And so
Yes, but
is that going to happen? Is that something that's going to happen, and why
it
or why
depends.
not?
I don't think so. So it depends. So this is a multi-variable question, right? Because like number one, how much reserves beyond the reverse repo market are substantially going to be affected here from QT once we get down to zero here? How much further or how much more pressure can the short-term funding market take? I think that we can see a bit of stress here, as we saw in 2018. I mean, like I said, let's go back to 2018 when the Fed was doing QT. It was normal, and will even enable the other both of these indicators, these rate indicators, the Fed funds rate and the SOFR rate. Which the SOFR rate, again, as I said earlier, they're the same but not the same. The SOFR rate is really just more traded. It's the preferred way to trade in the short-term funding market. And as you can see, that is well above the interest on excess reserve rate. So this is a key indicator that just because it goes above doesn't mean the Fed has to break, right? This is just a
Right.
good
And we're not
scenario,
even seeing anywhere near that kind of action right
right?
now. So there's still
So
quite a ways to go.
right. So I think it's almost, I don't want to say it's stupid, but it's almost ill-advised to say, oh, just because reverse repo is going zero. Reverse repo went to zero in February of 18, right? And as you guys saw, we went well beyond that while the Fed was still conducting QT. So the question now is, just because the RRP goes to zero, it's kind of stupid to say the Fed's going to have to stop. I think the Fed is not out here proactively worrying about causing things. They're more of like, we'll drive the car. If the wall is approaching, we'll wait until we pretty much smash the car into the wall before we step on the brakes, right? It's, they pump the market full of excess reserves just because they could, and they were scared. They wanted to avoid all types of recessions or any type of hardships. And then they claim that all that the excess reserves floating in the system, those inflationary effects were just transitory. And sure enough, they played that game until they couldn't anymore, and then they had to start hiking aggressively. They went from we're not even thinking about hiking rates to we're not even thinking about cutting rates. So I think that we have to let this game play out in the stages. Stage 3 is obviously in full effect right now. I don't think we can even look at any type of economic or financial stress in terms of the funding markets yet, until we start to see that SOFR rate really pick up and trade upwards of the IORB rate. And until that really happens, I think the economy is one thing, but the banking sector, which the Fed is really controlling when they're doing QT, right? They're sucking the excess reserves out of the banking system. They have some work to do here. So I don't think we can say that, now the next question is going to be this, right? We might as well bring this up, is there's 100 basis points of Fed rate cuts priced into the curve in the next 12 months. So is the Fed going to cut rates while still running QT? It's a question we need to ask, because it doesn't look like QT is coming anytime soon.
Do you mean
So is the
QE?
Fed? No, Q.
Well, we're
Excuse me.
already getting QT.
I'm sorry. I'm sorry. Is the Fed going to continuously run QT while also cutting interest rates? Because it doesn't look like we're going to get QE anytime soon. I apologize. You're right there. I said the same thing twice. Right? That's the question we have to ask, because if the Fed isn't going to stop QT, then they're going to run interest rate cuts here. I mean, marginal cuts is okay. I understand. Like we said earlier, we have to make sure that real yield doesn't run away on us, right? And get too restrictive too quickly. But to think that the Fed is just going to lop up cut after cut after cut and just bring rates down gradually down to 2%, I don't think that's a valid conclusion you can make, at least at this point in time. The reserves are well, and we're well flush with reserves at the moment. Even if this RRP is getting hit, you can make this a dramatic scene all you want, but it's quite apparent that, again, there's no stress in the SOFR markets yet. And until we start seeing that, I think the Fed is well aware of this, and they know that
there's no reason to end QT just yet.
Yeah. And I think that we're going to see some more stress in the short-term funding market before we see the Fed even thinking about cutting QT. Now, what could happen? Well, obviously, we can get a recession, right? A recession can emerge. That's possible. But that doesn't also look like it's going to happen tomorrow either, right? Because we're still in that, we still got the GDP nowcast in positive territory. We still got unemployment rate rather low, slowly climbing, but it's not there yet. And that's all, this is all what stage 3 is about, right? Look, stage 3 from the top, the stage 3 is the normalization phase, right? We're at the top. Everyone's like, okay, great. SOFR market's not breaking. Employment's not breaking. Growth is resilient. Stock market's not in shambles. Bond yields really aren't running away from us, but they've come up quite a bit, but they're not really, ripping and soaring. Inflation is not that issue anymore. So maybe the market's normalizing. This is exactly what stage 3 is about. It's saying, okay, nothing's breaking. We're all in the clear. And what ends up happening is you get to this point where you actually price in a continuation of a growth cycle, right? Because you're getting to the point where like everything's okay. So the drum can beat on and you still beat that drum, but you haven't addressed all the issues under the surface. And what you do is you add further fuel to the fire, right? You're adding further restrictiveness to the economy if it's, high, if it's trying to normalize interest rates, which means the 2s and 10s trying to revert, because if there's no recession right now, there shouldn't be a huge discount on the long end. That's what we saw happen since August. It reversed quite a bit. And that's pretty much a restrictive part of the economy. We saw mortgage rates go up quite a bit since August, right? We saw oil prices at some point go up quite a bit, but they've come down. And that's another signal that we might be getting to the end, closer to the middle/end of stage 3. We're still in stage 3. We're not in stage 4 yet. Obviously, our members know what we're looking for. On our website, in our members area, we listed exactly what needs to happen to get to stage 4, step by step. Follow along with us there. And once it hits, you guys will know. You'll be able to see it in real time. And the bond market and the interest rate market, like the short-term funding market, will all be signaling exactly what stage 4 is all about. Until that happens, we have to play the game that's in front of us, navigate this tricky economic environment day by day, follow our tools, and keep everything as simple as possible. At the end of the day, we want to compound our returns in the most profitable and directional scenarios we can. Other than that, guys, if you have any other questions, you can reach out to us on Twitter @TheMarketRadar or our website at www.market-radar.com.